Let's get across the market open now. Kyle Ryder joining us from Capital.com. Kyle, welcome back. Good to catch up with you as we round out. We'll get going on this Friday, I should say. And look, tech weakness across the board globally at the moment. What do you see as the driving force behind that?
Well, I think it's a narrative that's hard to shake, and I think part of it is quite fundamental. There's these concerns about chip demand going forward, and there's also concerns about the supply side of sort of the chip market too, which is to say that costs are picking up and there are competitive pressures picking up that is threatening margins going forward. But there's also this kind of big sell down that we're seeing in South Korea, steps being taken by authorities over there to try and curb some of this mania that we've seen. And I think there might be some sort of forced liquidations going on as some people who are holding some stocks are actually forced to liquidate their positions in South Korean names, also doing the same in similar names on Wall Street and other parts of the world. So you've had this sort of like miniature tech wreck going on, which, as I said, has some fairly critical fundamental factors behind it, but is also being driven very much by kind of a little bit of froth coming out of at least one very hot area of the market. And I think it's fair to say that everyone now is really looking forward to these earnings results at the end of the month to sort of re-anchor things back to a much firmer fundamental narrative and a narrative that can be a little bit clearer. But for now, it's that kind of two-way volatility in tech stocks. It's a fairly narrow decline, it has to be said, on Wall Street, or a fairly narrow set of names that are sort of really underperforming the market. But obviously, because of their weighting, it's weighing down on most of the major indices and obviously creating this kind of sideways trade that we've seen on Wall Street for the last couple of weeks.
Really high expectations in regards to earnings stateside there, obviously. Well, the banks hitting out of the park as such. Yet any sort of slight misses, disappointment in terms of forecasts are punished. We saw that again with Netflix overnight.
Yeah, I mean, whenever you see a growth stock showing signs that it might be X growth, at least on the top line, it's going to cause some jitters in the markets. And we sort of saw that last night. So it will probably be one of those earnings seasons where, losses are really heavily punished because there is that good news being baked into the markets, or a lot of good news being baked into the markets already. But if you sort of zoom out and sort of look at the earnings season so far, as you know, the banks have been pretty solid overall. There is this sense that we're heading for a pretty robust earnings season. The consensus estimate going into this week, which will probably be revised higher by virtue of the results that we've gotten this week, is for earnings growth around, sort of 23%. That is, as far as, a pre-earnings estimate or a pre-earnings season estimate, pretty much as high as we've had since, the pandemic boom that was obviously extraordinarily strong in terms of corporate profitability. And, rivaling what we got last quarter as well, which was around 29% earnings growth, albeit, coming from expectations, it was actually much lower than that. So, like I said before, this is really what investors are trying to anchor themselves in and are really kind of impatiently waiting for, is some of these heavy hitting names to come out, deliver their results, and, hopefully basically do what they did last quarter, which is, if you look at the Magnificent Seven names, pretty much triple expectations when it comes to their earnings and deliver really robust guidance to provide this reassurance that obviously earnings remain strong, but more crucially, that kind of structural story of the artificial intelligence boom continues. So far, it's kind of been a mixed bag. Probably as a result, we haven't had that catalyst in the market to push it higher, and this sort of other negative news has kind of weighed on things. But that's what everyone's waiting for with bated breath, is just more detail on the earnings front, because the bar is set high and investors want to see if, once again, that high bar is exceeded, as was the case last quarter.
Now, some fairly solid US data overnight, in particular retail sales. Yet that geopolitical risk remains, Kyle, with the US will continue to pound Iranian targets in the Middle East. Yet hasn't really seen oil move much over the past 24 hours.
Yeah, it looks like we're consolidating a little bit for oil. Pretty tight range, only moved probably a couple of percent here in both directions, which is relatively small, obviously, for certainly the volatility that we saw throughout March, April, and May when geopolitical risks were increasing. But even, compared to the last few weeks, as sort of the markets have rebounded to reflect this kind of supply side risk, as well as, just the geopolitical risk premium that has to get priced in, especially to the front end of the curve. I think the concerning development last night was that the conflict, or at least the rhetoric about the conflict, seems to be sort of broadening out, if you will. There was threats by the Iranians that if, the United States followed through with its threats to hit Iranian energy infrastructure, they would call in Houthi forces to block the Red Sea, which is obviously another critical choke point and a critical energy choke point. We've also got today, obviously, this speech in the next few hours from, President Trump, which is not expected to be about the war itself. It's supposed to be about, purported election interference and election integrity. But we've only seen really hot rhetoric coming from both sides. Very little indication for the time being that things are sort of de-escalating or that we're sort of moving towards a situation where negotiations are going to sort of move in a constructive direction once again. And therefore, I think the markets are going to be very sensitive to any kind of, heating up of the rhetoric and any kind of escalation, which there seems to be this kind of inertia, pushing both sides towards at this point in time. So it's one that could, really dictate the tone for the rest of the, trading week, the last 24 hours we have, because again, we've got these Trump comments, but as always, things tend to escalate over the weekend. Investors don't like to carry too much risk going into a weekend where, there is the possibility of a eruption in geopolitical tensions. So it could mean again that, oil is sort of skewed to the upside, risk assets sort of skewed to the downside, and it's just going to be very headline driven and inherently, quite uncertain as a result.
Yeah, Kyle, clearly markets will be hoping for some commentary from the president in regards to what the plan is, if he has one, in the Middle East. Now, meanwhile, gold coming under further pressure as well. It's well and truly below 4,000 now.
Yeah, and I think some of that solid US data has contributed to that, as well as the rebound in oil prices, putting some degree of pressure on the commodity as well. I mean, it has to be said, the kind of correlation or the cross-asset correlations that we saw through the first part of the war have broken down to sort of some extent, and that kind of war trade, as it were, where oil prices rise, lifting inflation expectations, interest rate expectations, mechanically lifting the US dollar, and therefore heavily weighing down on the gold price. It hasn't really materialized so much. We've seen sort of buyers jump into the market around that sort of 4,000 level, and it does seem to be a fairly significant, level of support. But the other side of this too is, of course, the US data story. We've had some reprieve in terms of the inflation numbers we've had over the last week or less than a week, suggesting that some of that inflation impulse isn't quite as strong as previously thought, and maybe that the Fed has a little bit of time before hiking interest rates, if it does at all. But on the other side of that, like you noted before, we had some solid retail sales data, we had some solid jobless claims data as well, and a Kevin Warsh testimony in the last few days, which really seemed to indicate that he's laser focused on getting inflation back to target, and he wants to be known as a guy that talks tough about inflation and really narrows the Fed's focus towards price stability. So it's a really sort of mixed environment for gold at the moment, a lot of crosswinds. And again, as a result, we've kind of traded sideways over the last, few weeks and just hovered above and below that sort of $4,000 per ounce level.